BNY Wealth Head of Investment Strategies and Equities, Alicia Levine. All right, so a week ago, it's great, by the way, it's great seeing you.
Thanks for having me back.
Always great seeing you. So a week ago, Bank of America had this out, and essentially they're saying, like, out of 20 potential metrics that signal the market being overvalued, 19 were, so they have your PE ratio in here, but it's not the only thing. So I guess the question is, though, is, you know, this is fine, but when do you say, okay, it's so expensive? Is there another part to this that makes you start to change your mind in terms of being bullish or bearish?
So, Charles, it's a great question because this has been floating around for about 18 months. Because for about 18 months, the market's been trading at 22 times forward earnings. And we've been hearing that the sky is falling because the sky is falling because the market is expensive.
Right.
The truth is, we're in a higher multiple regime, and we have been really for the last 10 years or so because corporate margins are so much higher, driving the forward PE on a sustainable basis higher. Now, earnings this year came in much better than expected, so we've seen the rally in the S&P. Right. Most of the rally, and including in NASDAQ, where everybody's worried it's so expensive, is actually due to earnings beats and not because of multiple expansion.
Right. So the bottom line is this is a fundamentally driven rally. This is not a hysteria-driven rally.
It's not a hysteria-driven rally. There are pockets of excess in the meme stocks and all that, and our investors are not involved in those. So that's something to pay attention to. But otherwise, we see this as fundamentally driven, and we think we rally into year-end because essentially we're still in a Fed cutting cycle. The Atlanta GDP now is at 4% for this quarter, and earnings cycle is looking better with the third quarter earnings looking to be up 4% from the 6% expected just 6 weeks ago.
Right.
So what's not to like here?
Right. And by the way, I read somewhere that speaking of margins are expected to continue to go higher into 2027. What would be a negative surprise then? You mentioned, what would be something that constitutes enough of a negative surprise that you go back to the drawing board?
So I'd say the real issue here is whether or not the earnings can continue to beat, because now the market's getting used to beats.
Right.
So you have to see it. I think there was some wobble on the Mag 7 earnings reports because there was more spending from some of the components than would otherwise be liked. And not just because they're spending, because they have to go to the debt markets.
Right.
So before, this was all being driven by cash or equity. And now the spending's driven by debt. But I'll just remind your viewers that, of course, the tax bill, the one big beautiful bill, favorably disposed the P&L for CapEx and for interest, interest expense.
Right.
So it's not all bad, okay?
Right. So
but
it might have been a red flag or a yellow flag a year ago, but now it's smart business.
Now it's smart business because the companies are working under the assumption that there's a first mover advantage in AI, and until we see otherwise, that will still hold and be the case.
So you are kind of, you're watching monetization of CapEx, the valuations we talked about in the labor market, which at some point, I'm interviewing the labor secretary in a moment, so maybe I'll let you know when we get some official data. But I want to talk about the drivers for this rally. I want to bring that up because we're running out of time. This is the bottom line for you, right? I mean, especially going into next year.
And a friendly Fed. Right? Because the Fed, the presser, Jay Powell said we may be on pause. December is live. It's not a sure thing, but we actually think they're likely to cut in December as well. Yeah,
we went from over 90% to 60, and then we've been in the 70-ish area.
But what it did do is it hurt the performance of small caps and EM.
Small caps, they can't catch a break.
Cannot catch a break, and we would have thought that would have been great. So you watch small caps for any turn, and actually that's your Fed cutting cycle play.
The irony is that they're expected to have the best earnings growth next year. Like if the earnings growth is what they think it will be, small caps have to be a monumental buy at some point real soon. I can't let you go though without talking about sector allocation. I know they like U.S. and EM, but financials, technology, communication services, utility, and industrials. I mean, that kind of speaks for itself.
It does speak for itself. Utilities, typically a sleepy sector, but this is the heart of the AI boom and the build out and the CapEx, and so we think you have to be involved there. Great to see you.
Always great to see you.
Thank you
so much. Appreciate it.